Here is a quick checklist on exactly what's going on, right? This is the bullet point list of changes. So you have income tax brackets locked in, a bigger standard deduction. I'm getting asked all the time about the Social Security taxation for seniors. That didn't change the way they tax it, but there's a new senior deduction temporarily, which could impact your overall taxes that you pay. There's an expanded SALT deduction, continued higher estate tax exemption. So a lot of folks maybe aren't hit by that, but maybe you are, depending on your estate size. A new child savings account called the Trump account, new deductions on tips and overtime and car loans temporarily, and the child tax credit increased. So those are the bullet points. So great. Now what? What do you do with that information? So you have action number 1. Here's some things you can actually do. Because look, the 2017 Tax Cuts and Jobs Act, it lowered income tax rates for most people through a combination of increasing the upper limits of each tax bracket and lowering the tax rates. So in that 2017 Act, these changes were scheduled to sunset at the end of this year, meaning that the higher rates and the smaller tax brackets would go back into effect. So the new law makes sure those tax cuts are permanent. So anytime I hear tax cuts and permanent in the same sentence, that sounds good to me. So for most of us, income taxes will be lower than they were prior to 2017. Awesome. So now that we know what the tax rates will be going forward, it really allows for more certainty in the planning that you do. Action number 2, you might also remember that the standard deduction doubled in 2017 from $6,500 to $12,000 for individual filers, and then from $13,000 to $24,000 for joint returns. So that law also eliminated or got rid of many items that were available for itemized deductions. And so those two pieces led to fewer people using itemized compared to standard. And so the higher standard deduction is staying. It's indexed for inflation. It's now $15,000 and change for single and $31,500 for joint filers. So that's a pretty decent increase. Of course, this is for 2025 taxes that you'll pay in April of 2026. There isn't any change to the current senior deduction of $2,000 for one person or $1,600 per person if married. Right? So you would actually get $3,200 versus $2,000 if you're single. Action number 3, the bill implements a new $6,000 tax deduction for seniors age 65 or over for the next 4 years, although you see it phases out at higher incomes. So beginning at $75,000 for single filers or $150,000 for joint filers, that deduction will phase out. But the big question I get is, well, what happened to Social Security taxation? Are they getting rid of this federal income tax on Social Security? Because, I mean, we all know how it goes. You pay tax when you make the money, then you pay tax again when you use the money. It's just really, folks. But hey, at least the government spends it wisely. So Social Security is still going to be taxed at the federal level, but because of this deduction, you may be able to pay less total income tax and therefore less on your Social Security. So better than the kick in the head. All right, let's see. Action number 4. This one you definitely want to maximize because state and local taxes is what allows you to deduct from your federal income taxes, of course. So when the 2017 law imposed that $10,000 upper cap on how much could be deducted, that was a big deal to higher income people in high tax states. So the most impacted were California, New York, New Jersey, Connecticut, Massachusetts, and Illinois. But the new law now increases that SALT deduction cap to $40,000, so state and local taxes. And it increases 1% a year. So that begins to phase out at higher incomes as well, but the limits are $250,000 for a single and $500,000 for a joint. And then assuming no other law changes, by 2030, the $10,000 cap is going to go back into place, but who knows by then. So planning your estate, the gift tax and estate tax exclusions, those are the amount that you can give as gifts over your lifetime without any federal tax implications, right? The chart is showing that the rates doubled in 2017, and they were scheduled to revert back to those pre-2017 levels at the end of this year. But just like the income tax bracket and the rate changes, the changes are now permanent, which is great. The lifetime gift and estate tax exclusion is going to increase to $15 million for single filers and $30 million for joint filers. Now, I don't know about you. I don't currently have that problem. Okay. But maybe some of you do, right? And so if you're lucky enough to have to wonder about that, then basically when the amount increases, then you'll be able to give up to the new amount. So for example, in 2025, the amount for a single filer is just under 14 million. So if you gift that amount, you can gift approximately a million in additional funds in 2026. So who knows? If you hit the lottery or you have businesses, maybe some of you are impacted by this. But anyway, it's a great time for multi-generational wealth planning now that we have the certainty going forward, right? It's a really good time for that. Okay, child savings account. So first, let's start with the free money. Children born between January 1, 2025 and December 31 of 2028 qualify for $1,000 in federal seed money for one of these child savings accounts known as a Trump account. No income limitations on this. The only requirement is that the child is a U.S. citizen with a valid Social Security number, and at least one parent must also have a valid Social Security number. So this one's a no-brainer, but there's two questions in, right? So we've established that it would be foolish to not open an account if you can get the $1,000 seed money, but should you continue to add to it? And then if you have a minor child born before January, you can open an account for them, although you're not going to get the seed money, but is that a good idea? So the answer to both those questions is maybe, because it's complicated. These accounts have rules and several aspects are still unclear. Big shock, the government made something unclear, right? But if we look at your specific situation to see if it might be better off sticking with a traditional 529 for education or a traditional IRA. But anyway, here's what some of the rules seem to be. But again, it's a bit unclear. So parents, family members, or other taxable entities can contribute. It converts to a traditional IRA when the child turns 18. The funds are untouchable until the child turns 18. Employers are allowed to contribute $2,500 of the $5,000 annual limit. If they do, it doesn't count against income for your child. That's good. No earned income requirements like IRAs. Your proceeds have to be invested in a low-cost index fund. You know, one of the ones that basically track the S&P 500. Account holders are allowed to make partial withdrawals when they turn 18 and access the full amount at age 25, but only for qualified purposes, including paying for college, starting a business, or buying a first home. Now, if you withdraw for qualified purposes, then the distributions will be taxed at capital gains rates of 15 or 20%, which is typically lower than regular income tax rates. And they get full access to use the funds at age 30 for any purpose that they want. Bunch of bullet point rules there for you to think about. All right, a couple more slides here. Charitable deductions. So you have to know the deductions. And this one impacts me. I'm like, okay, I haven't figured out my own taxes yet, so I'm kind of eager to get into all this myself. But charitable deductions for non-itemizers are back with a limit of $1,000 for single and $2,000 for joint filers. So before, if you did standard deductions, then you could give money away and you didn't get anything for it, right? You'd have to do itemized. But there are some new limitations, and you'd probably definitely, How about we'll go definitely. Check with your CPA or accountant on this one. Tips and overtime. Tax relief comes in the form of tax refunds. So that if you are a waiter or waitress, you get tips. You still have to pay the taxes when you make the money. You claim all this on your income tax return, and then come tax time, that's when when it's settled up, right? You'll get a refund based on those taxes that you paid. So both of these deductions, the charitable and the tax or the tip and overtime, they phase out at $150K for single and $300K for joint filers. And those are set to expire also in 2028. Car loans, I thought that was interesting. So a deduction of up to 10K is available to single taxpayers with modified adjusted gross income of 100,000 or less, or 200,000 for joint filers. So if you're already thinking about buying a car, which I was not, and it wasn't enough to push me over the edge because I'll run that thing till it dies. Okay. But this would be a great deal, I think. Buy a new car, get 10,000, and it would only apply to loans for purchases made between 2025 and 2028. And it does look like if you wanted to buy 2 or 3 cars, right? It looks like you can get the deduction more than once if you bought more than one car. But again, I'm not sure on that because some of this stuff is unclear. So get with your CPA. Action number 8. And it sounds a little redundant. Yeah, I covered it. I'm going to skip this redundant. My apologies there. Okay. So child tax credit, don't know if any of you are impacted by it. Obviously not you personally, but I mean in your family, if you have kids that just make sure they know about it, right? If you have any grandchildren. So again, this doesn't start to phase out until income levels of 200K for single or 400K for married filing jointly. So lots of room to get this one. A tax credit, by the way, is better than a deduction because it comes right off the top line, not the bottom line. Sort of like if you think of it as a store credit or a gift card on Amazon, you made a return, they put the money in your gift card. Great, it just goes right off the top of the cost. This is for every child under age 17 at the end of the tax year. So the tax credit increase to $2,200. All right, so just to recap, basically your income taxes is going to be around the same, is generally the case for most people. You'll have access to that new $6,000 deduction if you're less than 75 and 150, and I'll get a printout to put more detail on that afterwards. Social Security taxes will likely be similar. Hopefully, you're able to decrease your income a little bit with a deduction, which will then decrease income tax on Social Security. Higher gift and estate tax exemptions will continue. You may qualify for a higher SALT deduction. I hope I do. And you may want to contribute to a child savings account for your grandkids. That is it in a nutshell. So if you want to get a one-on-one conversation or just, get into your current situation, you can always call me at the number there or go to my website and hit the schedule now button. Either way, you're going to have an AI, which some of you talk to. She answers the phone instead of you going to voicemail for an indefinite amount of time. She answers immediately. And, then I check the messages as soon as I'm free and can proceed from there. And she'll help you book an appointment right onto the first open spot on my calendar. Or you just hit the button and kind of go that way. So let me open it up for questions. Anybody have anything else you want to ask or chat about?
So
there we go.
The big beautiful bill does not even have any effect on the Medicare, right?
No effect on the Medicare. Yeah, I'm trying to think of any indirect effects. Nah, not of this bill. I mean, the biggest changes to the Medicare and it was the drug piece from last year, and that was, the fact that they capped the expenses. So even if your drugs cost 10 grand for the whole year, all you're going to pay is 2. The companies have to eat the rest, or the insurance company has to eat the rest.